Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 151. And in this episode, we're reviewing the performance of the global markets during the 11th week of 2025. And that is from Monday the 10th to Friday the 14th of March. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where on Wednesday, the Bureau of Labor Statistics reported that the prices for goods and services increased at a slower than expected pace in the month of February, and in the process provided some relief as consumers and businesses remain concerned about the possible impact that tariffs could have on inflation going forward. According to the Labor Department, the Consumer Price Index, which is a wide-ranging measure of prices across the U.S. economy, this index ticked up by 0.2% for the month, whilst the annual rate of inflation came out at 2.8%. And excluding food and energy prices, the Core Consumer Price Index also rose by 0.2% on a monthly basis and was up by 3.1% on a 12-month basis, which was the lowest annual reading since April 2021. Meanwhile, economists surveyed by Dow Jones had been looking for a monthly increase of 0.3% for both headline and core inflation, with the respective annual rates projected at 2.9% and 3.2%, which means that all the estimated rates was 0.1 percentage points higher than the actual readings. Staying in the United States, on Wednesday, Ray Dalio, the founder of Bridgewater Associates, warned that there was a significant supply-demand problem with regards to the United States national debt, which could have a profoundly disruptive impact on the global economy. In his latest warning about America's mounting debt, the hedge fund billionaire noted that the United States requires to sell a huge amount of debt, which the rest of the world probably doesn't want to buy. Dalio was speaking at the Converge Live in Singapore, where he said that the supply-demand problem could result in the restructuring of America's debt, with the likelihood of the US applying pressure on other countries to buy their debt or even cutting off payments to some creditor countries. The US debt problem continues to worsen, with the latest data showing that the budget deficit as at February 2025, which is 5 months into the current fiscal year, had already surpassed the $1 trillion mark. America's national debt currently stands at more than $36.2 trillion, with the budget deficit projected at 7.2% of the country's gross domestic product, and with the actual deficit estimated at about $1.15 trillion, which is for the first 5 months of the current fiscal year, which ends in September 2025. On Wall Street this past week, stocks rallied on Friday, clawing back some of the losses incurred during the week as investors got a reprieve from tariff-related headlines. Stocks bounced back on Friday after the White House opted to stay mute on tariffs for a change, helping to ease concerns around escalating tensions for the time being. A sharp decline of more than 1% on Thursday pulled the S&P 500 back into correction territory, which means a decline of at least 10% from recent record highs. Meanwhile, big tech shares that were rattled earlier in the week saw a sharp recovery on Friday, with Nvidia shares popping up more than 5%, whilst Tesla jumped nearly 4%, and Meta gained close to 3%. In summary, the Dow Jones Industrial Average rose 674 points to close at 41,488, and it was the best day so far in 2025 for both S&P 500 and the Nasdaq, with the S&P 500 climbing by 2.1% to end the week at 5,638, and the tech-heavy Nasdaq Composite advanced by 2.6% to settle at 17,754. And in related news, Elon Musk's foray into American politics has put downward pressure on Tesla's sales and share price. Musk's support for President Trump and his leadership of the Department of Government Efficiency has sparked public backlash, with Tesla shares down about 45% so far this year. In the Treasury bond market, the yields on U.S. Treasuries rose on Friday as investors digested the latest consumer sentiment data that point to higher inflation expectations. A survey from the University of Michigan showed that consumer sentiment dropped to 57.9 in March compared to the consensus estimate of 63.2. The report also indicated that consumers expect inflation to peak up at about 4.9% over the next 1 year. This report suggests that the U.S. economy could be heading into stagflation, which is a term used to describe an economy that is experiencing slow economic growth, which is also accompanied by inflation and a high unemployment rate. The Federal Reserve is set to meet this coming week, and according to the CME's FedWatch tool, traders are pricing in that the central bank will keep its policy rate on hold this time around. In response, the yield on the benchmark 10-year Treasury bond was higher by 4 basis points at 4.31%, whilst the yield on the policy-sensitive 2-year Treasury note was up by 7 basis points at 4.02%. For your information, bond yields and prices are inversely correlated, and 1 basis point is equal to 0.01%. In the crude oil market, the price of oil rebounded by about 1% on Friday to end the week broadly flat as investors weighed the diminishing prospects for a quick end to the war in Ukraine that could bring back Russian oil supplies to the markets in the West. On Thursday, Russian President Vladimir Putin said that in principle Moscow supported a U.S. proposal for a ceasefire in Ukraine, but sought a number of conditions that appeared to rule out a quick end to the fighting. After falling 1.5% in the previous session, the price of Brent crude recovered by 1% to close the week at $70.58 a barrel, whilst the US benchmark, that is West Texas Intermediate crude, which had lost about 1.7% on Thursday, this also rebounded by 1% to come to a close at $67.18 per barrel. In the precious metals market, for the first time ever, the price of gold broke above $3,000 an ounce as President Trump's tariffs against major trading partners continue to disrupt the financial markets and push investors into safe haven assets as they seek protection against elevated inflation and a possible economic recession. This latest move comes after the US stock market lost about $5 trillion in market capitalization over the past 3 weeks as Trump's trade tariffs continue to stoke confusion and uncertainty. Global central banks have also helped to fuel the rally in gold as they continue to increase the amount of gold held in reserves as an alternative to the dollar and US treasuries. Since the Russian invasion of Ukraine in 2022, governments are worried that the United States could weaponize the dollar against them, as was the case with Russia, whose foreign reserve assets were frozen in response to the invasion. According to the World Gold Council, central banks purchased 18 metric tons of gold in January 2025, following from an addition of 1,045 metric tons, which they added to the global gold reserves in 2024. The price of spot gold has risen about 13.6% so far this year and eventually closed the week at a new record high of $3,001 per ounce. In the cryptocurrency market, the price of Bitcoin dropped below $80,000 on Monday, dragged down by continued selling pressure in the equities market and heightened fears of a recession triggered by trade tariffs. According to CoinShares, in totality, the spot Bitcoin exchange traded fund recorded their 4th consecutive week of outflows as they logged in a total of $867 million in outflows this past week. According to CoinMetrics, earlier in the week, the price of the flagship cryptocurrency fell to as low as $77,400, which was its lowest level since November 2024. However, Bitcoin recovered later in the week to eventually come to a close at around $84,600 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling dipped slightly versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.43 compared to 129.23 that was recorded the previous week. Meanwhile, the sterling pound was priced at 167.37 and the euro was valued at 140.89. And on the regional front, one Kenya shilling was changing hands for 28.33 Ugandan shillings and 20.67 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.85. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by an astronomical $913 million for a grand total of $10.055 billion, which is equivalent to 5.1 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this massive increase, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. The massive increase in reserves could be attributed to the net difference received from the recent issuance of a new Eurobond for $1.5 billion, whose proceeds were used to buy back the 2019 Eurobond for $900 million, leaving a balance of about $600 million. Please note that the central bank does not provide any explanation for the change in foreign exchange reserves, and despite my earlier request and several reminders, there has still been no response from the central bank. On diaspora remittances, the inflow of remittances in February 2025 totaled to $382 million, compared to about $386 million in February 2024, which was a decrease of about 1%. Meanwhile, the cumulative inflows for the 12 months to February 2025, this increased by 14.5% to $4.956 billion, compared to $4.33 billion for a similar period in 2024. The inflow of remittances continues to support Kenya's current account as well as the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya, accounting for about 53% of total remittances received in February 2025. In the money markets, the interbank market was sufficiently liquid during the week and was also supported through open market operations, which remained quite active. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is a rate that banks lend to each other on an overnight basis, this was relatively stable at 10.69% compared to 10.71% the previous week. And in terms of volume, the average value that was traded in the interbank market, this increased to 19.5 billion shillings, up from 12 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 13.5 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 13th of March, and the central bank received bids totaling to 35.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 149%. The central bank, however, ended up accepting only 26.8 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by less than 1 basis point to average out at 8.91%, whilst the 182-day rate declined by about 3.6 basis points to level off at 9.11%, and the 364-day rate was down by 2 basis points to settle at 10.47%. And just for your information, as at the end of February 2025, the percentage of treasury bills that makes up the country's total domestic debt hit a 2-year high of just above 15%, reflecting the increased demand for short-dated government securities as interest rates continue to decline. The share of treasury bills as a percentage of total securities issued has grown from a low of 11.35% as at the end of December 2023. According to the latest data from the Central Bank of Kenya, the total stock of outstanding treasury bills stood at 887 billion shillings as at February 2025. In the secondary bond market, there has been a noticeable increase in trading activity in the secondary bond market so far this year, reflecting increased investor demand for specific infrastructure bonds that are trading at a premium following the gradual decline in interest rates. Infrastructure bonds are now in high demand following a sharp decline in yields after the central bank reduced its base rate from 13% in August 2024 down to 10.75% in January 2025. And given the inverse relationship between bond yields and prices, as yields have fallen, bond prices have consequently risen. Data from the Nairobi Securities Exchange shows that the turnover in bond trading for the first 2 months of 2025 was valued at 407 billion shillings, which was a 23% increase compared to a similar period in 2024. In the Eurobond market, during the week, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 13-year 2021 Eurobond increasing the most by about 20 basis points as it rose from 9.9% the previous week to 10.10%. At the Nairobi Securities Exchange, during the week, the equities market was on a downward trajectory, with the NSE 20 declining the most by 4.3%, whilst the NSE 10 lost by 3.3%, and the NSE 25 and the NASI both dropped by 3.1%. This takes the year-to-date performance to gains of 8.6% for the NSE 20, 3.4% for the NASI, 2.1% for the NSE 25, and 0.5% for the NSE 10. The stock market performance was driven by losses recorded by large cap stocks such as Standard Chartered Bank, Cooperative Bank, and Kenya Commercial Bank Group, which declined by 12.4%, 10.9%, and 5.8% respectively. It's earnings season for the domestic banking sector, and during the past week, Kenya Commercial Bank Group released their financial results for the full year 2024, and these results showed a 66% increase in the gross profit, which rose from 36 billion shillings in 2023 to an impressive 60 billion shillings in 2024. The bank's total operating income in 2024 rose by about 24% to 204.8 billion shillings, and this was mainly attributed to a higher net interest income. KCB Group has announced a final dividend of 1 shilling and 50 cents per share, which brings the total shareholder payout in 2024 to 3 shillings per share. In related news, Absa Bank Kenya has announced plans to launch an exchange-traded fund that is linked to the Morgan Stanley Capital International World Index, and this will be launched at the Nairobi Securities Exchange within the second quarter of 2025. For your information, an exchange-traded fund is an investment fund that pulls together a group of securities, which is then split into units that can be bought and sold like individual shares. In this particular case, the underlying assets in the Morgan Stanley World Index, which is composed of about 1,400 companies that are listed across 23 developed economies and includes blue chip companies such as Apple, Nvidia, Microsoft, Amazon, Meta, Alphabet, and even Tesla. This will be the second exchange-traded fund to be listed at the Nairobi Securities Exchange, the first being the Absa New Gold ETF, which was listed in March 2017 and tracks the spot price of gold in the global markets, giving domestic investors exposure to gold. Up next is our topical issue. And this week, we are looking at dollar-denominated assets under management. Despite the recent stability of the Kenya shilling exchange rate, investors continue to increase their investments in foreign currency assets. The latest data shows that the value of dollar-denominated assets under management has more than doubled in the past 9 months, growing from about 19 billion shillings in March 2024 to hit an all-time high of about 42 billion shillings in December 2024. The Capital Markets Authority has confirmed that it has approved a total of 26 dollar-denominated funds, with the Sanlam Fixed Income Dollar Fund being the largest dollar fund with about 12 billion shillings in assets under management. Growth for the dollar funds has been attained despite the stability of the Kenya shilling, indicating investors' desire to maintain diversification across multiple currencies. From 2023 into 2024, the Kenya shilling depreciated sharply versus the dollar to hit an all-time low above 160 shillings, driven by concerns about the repayment of the 2 billion Eurobond that was due in June 2024. However, once this issue was resolved, the Kenya shilling recovered and stabilized at about 130 shillings, where it has been ever since. The depreciation of the Kenya shilling is what initially sparked an interest in dollar-denominated assets as investors sought to hedge their portfolios against a weakening shilling. But despite the recent stability in the Kenya shilling, investors continue to increase their investments in dollar-denominated funds, which indicates prudence in terms of portfolio diversification, as well as a hedge against further currency depreciation. But more importantly, it sends a signal that the outlook for the Kenya shilling remains uncertain. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please consider supporting this podcast by becoming an active subscriber. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, we are here in this place and time to observe, to learn, to grow, to love, and then we return home. Think about it. Thank you, and God bless.